On Sky News Business, this is Equity Investor with Julia Lee.
Welcome to the show. I'm Julia Lee from Bell Direct. On tonight's show, Banking Bad, the Financial Services Royal Commission spotlights dodgy advice, revealing 300,000 Australians were charged fees despite no service ever being provided. Dairy deal. A2 Milk makes a strategic jump into South Korea while the dairy darling signing a new deal with pharmaceutical Yuhan. And the biotech bandwagon, where to bet on for a big win when buying into biotechnology. And my guests tonight, Michael Wayne from Magellan Financial and also Kim Slater from County Securities. And you can reach us at eq@skynews.com or hashtag Equity Investor. And of course, if you want to ask your question live on air, just include a contact telephone number and we'll ring you right back. Let's start by having a look at the markets, and what a day for the markets. We have seen the markets, I guess, pricing out escalated action over in Syria. And I guess one of the things that has been playing on a lot of investors' minds is the oil jump. The oil prices jumped 8% last week. Can it continue? We also saw Blue Sky reaching a new low post-Glukos report, and we saw A2 Milk once again making its way back after that deal in South Korea. Let's have a look first at our first email. What are your thoughts on Cenex at current prices? Is this an opportune time to buy, or have I missed the boat? From Abe in South Australia. Of course, we're looking at an oil company here, and oil prices have done well over the past week. I guess this depends on your outlook for the underlying oil price as well as some of the projects that Cenex has. I mean, Michael, looking at Cenex Energy, is this one that interests you?
It's never one that I've invested in or had clients invest in, but it's one that's been around for a number of years, and there's been some positive sentiments towards this company. They do have a very high quality resource, not too far from Santos in the Cooper Basin. But the big thing for them is whether or not they can develop that resource, whether they can get the funding arrangements in place so that they can go out and explore the various exploration regions that they've come to. So look, Look, if they do get it right, it could be potentially one of those things that does take off, but there's still a lot of different phases that they've got to go through before they start getting all this gas to market. So they have decided, I think, to build a lot of their own infrastructure as well, so they're not going to be tolling, as they call it, off the likes of Santos and Gladstone, but Santos is a partner as well with them in this project that they've got going.
I mean, what a wonderful looking chart, from the lows of about 24 cents to almost doubling in share price. I mean, there's a lot of the optimism already priced in here, Kim. I mean, Michael's spoken about Santos, and there's been speculation from time to time that it's a possible takeover target, that perhaps we could see Santos or one of the other oil majors making a bid for Cenex Energy. What are your thoughts on this company?
I think it's got further to go, Julia. There was an announcement, there's been a recent announcement out that they've just done another deal with Beach, which involves $43 million of additional exploration funded by Beach in the Cooper. So your point about takeovers is valid, because obviously, you know, corporate raiders are looking further down the tree at the opportunities, and the Cooper Basin still has quite a bit of resource exploration in the unconventional gas side to go. So I think you could possibly see this, given the climate that we're seeing for oil prices, maybe get into the 50s, possibly the 60s.
Okay, so liking Cenex, I mean, Michael, what do you see as a potential here? Because surely prices, oil prices that we're seeing at the moment, around 65 US a barrel, already priced in. So unless you're extremely bullish oil, you think there's going to be a takeover, are there any other reasons that you'd be entering in at this point?
Well, as you point out, there's a majority shareholder. One of the big shareholders in Cenex is also one of the big shareholders in Santos, and that could potentially lead to that acquisition. And there might be that bit of a premium priced into this share price based on the fact that this acquisition might transpire at some point down the track. But it's hard to work out at the moment whether the share price is just moving higher because the oil price has been moving higher, or there's something more afoot. But there are a number of positive attributes to this company where if they can get it right, they can deliver these projects on time without any cost blowouts, then there's a decent business there for sure.
So putting you both on the spot, if you had to pick an oil and gas company, would it be Cenex or something else that's your favourite, Michael?
Well, we've had clients actually in Santos, which was a bit of a move away from our investment strategy, and this was going back maybe 18 months ago now. They were doing a lot right on the company level, so they weren't just relying on the oil price moving higher. They were getting their costs down, they were getting their headcount lower, they were paying back a lot of debt, and there was also a lot of takeover speculation, a number of bids coming through for Santos. So that's one that we've had clients in. We've probably started to sort of get them out after the big recent run-up, just in case the recent speculation doesn't come into play. But there's others like Oil Search, which has some very good resources as well. But by and large, we tend to be underweight energy just because it can be quite a volatile space.
Okay, so your favourite stock in this space?
In Santos.
Santos at the moment. And how about you, Kim?
Look at Julia, one at the bigger end of town, which is Woodside, which is always good for that, that exposure to what's happening in the geopolitical sense. And the other one's Beach Petroleum, which is a bit of emerging as a significant player with some interesting developments across a geographical region in Australia. So I think that those are two that are worth watching.
So lots of ideas in that oil and gas space. Let's go to our next email. This one says, could I have your opinion on the medium-term future of Domino's Pizza and Reliance Worldwide? This one's from Anne in Victoria. And what a great question. One stock has been pretty much shooting the lights out. It's obviously not Domino's in this share price here. And the other one has been under pressure. So let's start off with Domino's. And having a look at Domino's, I guess the key question is all the downside now priced in, and what you're banking on is, a bit of a turnaround in the business. It's not only an Australian pizza business. They operate in New Zealand, but also France, Belgium, Netherlands, Germany, as well as Japan. So, Kim, looking at Domino's, is there any downside to come, or is it all priced in now and it's just about waiting and being patient?
We always used to laugh about this stock, Julia saying, when you order the pizza, you throw the pizza away and eat the box.
Oh.
But I just don't. I don't like their franchise model. It's always driven from the point of view of costs, and incredibly difficult to make, or easy for Domino's, but for the franchisees who are really at the coalface. And Domino's relies on them for their profitability, and that's where they're loading in the costs. And it's always a business that requires expansion to fund profitability. And that model's been called into challenge, as we saw with Retail Food Group. So yeah. I think it's probably got more to go on the downside until it finds more of a realistic valuation, and I think we're still some way off that.
So you don't think the European expansion is enough to drive growth at this point?
Look, possibly it is, but it's a continual momentum machine, and I wonder if they've got adequate, if the sorts of issues that they've been seeing in Australia are not going to be transplanted to some of these other regions in which they're operating in.
I love pizza, Michael.
I don't think you can always pizza, Julia.
And if all the pizza shops were closed, I would eat Domino's Pizza. I also order from Crust, which is a Retail Food Group brand. Michael, where do you stand on Domino's?
Look, Domino's was a market darling. At one point, up around $80, trading on unbelievable multiples. The market's repriced their expectations clearly, and there's potential for those expectations to be lowered even further. They've cited some issues starting to creep in with the likes of Deliveroo and Uber Eats starting to come into the market, offering more choice for people. The big driver for Domino's is going to be the European business. They've got about, 800, 900 stores in Europe. They're looking to get that up to over 2,000 over the next couple of years. If they can continue the rollout at a good pace and at the same time get the margins in Europe to the same levels that we've seen here in Australia, then that's going to be the big issue. That's
precisely the problem with the model, is the margins that they need to build into the business, and that's where the competitive nature of this fast food business makes it really difficult to expand. Because your prices are always under attack from your competitors.
So even at $40, it's a no for you, Kim.
No,
Michael,
I think what's the multiple on this stock? It's still 40.
It's still quite high. It got up to about 80, but now it's close.
No, to 40. It's just. I think there are less. I'd rather put my money in a term deposit at the CBA Bank than invest in.
Michael, how about you? Do you think the downside's priced in?
Look, I think everything has its price. At the moment, the momentum's too poor. The momentum coming out of management with their announcements is also quite negative. They need a Herculean second half to meet their guidance for the 12 months. So they're disappointed in the first half. They need to go over and above in the second, and it's looking less likely as each week goes by.
I think you see this down into the low 30s quite quite easily.
Oh, wow. And what would change your mind, Michael, about the Domino's thing?
Oh, I think it's just some positive announcements. I mean, they're still growing at around sort of 20% or so, but I think you've got to start to see the European business really start to pick up. They've got operations in Japan as well, which have been a bit sluggish. It's one of the most shorter businesses, not only on value, but on volume as well. So you want to start to see those sorts of things turn around.
Kim, if you started to see same-store sales picking up in Europe as well as Japan, would that change your mind around Domino's?
It possibly would, but then I'd be looking at where the margins are in this business. I think that's the critical thing, because it's an incredibly competitive business to be in, and you know, every cent. I mean, Domino's is branching out into trying to use new technology to make sure that the pizzas are cooked better and delivered in a shorter period of time, and that's possibly, you know, with the use of drones and all those types of things. But, you know, wherever they can save money is obviously critical to the success of their business. But I still think that it's just too much. There's just too much volatility in the share price. Great if you want to trade it. You don't want to.
Okay, so no from Domino's. The other stock was Reliance, and this is a little bit different. We're looking at plumbing products, and I guess the key product is SharkBite. Interesting company, given about 72% of sales actually comes from the Americas, so very much an international company. Michael, looking at Reliance, what a beautiful looking chart.
Momentum in the business has been very good as well. They've managed to get themselves into, I think, Home Depot and Lowe's in the United States. And you could argue that the US housing market's probably closer to the beginning of the cycle than here in Australia. So there is the potential for this business to continue the strong momentum that it's had. So, look, it's one that I think can continue to do well despite the big run-up in share price.
It's really interesting that this is a fundamental change in plumbing, and I know you don't know a lot about plumbing, Julia.
I know it can be complicated, but the SharkBite, it's all about just putting it together.
And you know, the traditional way of doing it was, you know, they had oxy and then welded.
Didn't you used to have like male and female parts that had to go together?
But they put it together, and plumbers now just the new generation of plumbers just use the SharkBite, which cramps it together, and you never have any problems. But the interesting,
you don't have leaks.
Don't have leaks.
Okay.
So the interesting thing about the US market is not only the new housing market, but the size of the renovation market.
Do you think people are DIYing plumbing?
Not so much DIY in plumbing, but also when they go to replace, or they're doing bathroom renovations or kitchen renovations. Obviously, this is where this product is bought through the Home Depot stores by the contractors.
Yeah, and that's huge, being stocked in both Home Depot and Lowe's. I mean, there was a lot of speculation that when they won the extra contract, that the other would stop stocking a lot of the products. Do you still see that as a risk, Michael?
Look, it is a potential risk at some point down the track. Obviously, there's also risks that you start to get your margins compressed by the big dominant player in those cases. So they're things to keep an eye on. But the most recent bout of reporting, things like margins, things like ongoing growth, looked very, very promising. And the outlook and the outlook statement by management was also quite good. So
I think to a certain extent their market position is a little bit protected with those types of retailers, because it's a brand product that the retailers need to have on the shelves, because people are coming in and buying it. So if you actually get to the point where you try and drive the margins too low and you lose the range, the retailers lose the stocking of the product, which drives other traffic to the store as well.
So interesting product there, great earnings momentum here as well as price momentum, the opposite of Domino's. Let's go to another email. Here's one on biotechs. I heard a discussion on biotechs last week. How does one in Australia buy an overseas biotech? Can you suggest any local biotech companies that would be good to invest in? And this is from Hillary in New South Wales. Of course, these days there's a whole range of options. Michael, what's your favourite?
Look, in terms of buying, to answer the sort of first part of the question first, you can just simply set up an international trading account. Many of the discount brokerages offer that, and that's the way you can play it. In terms of local, I mean, CSL's the one that everyone sort of knows, the largest healthcare company on the market, and they're pretty much a conglomerate of all different biotech businesses. That's maybe the safest way to go down the path, because biotechs traditionally can be quite risky. Some ones like Certex, which recently got acquired, is a success story of one that was started off pretty small, made the transition. Botanix is a very small one. It's about 80 mil market cap that I've had clients raise with me before, basically looking into acne treatments. So acne treatments, although They're quite effective at the moment. They can have some terrible side effects. Botanix has gone through a number of different processes and they're looking quite okay. But do bear in mind it is a very, very volatile space. There's a big sort of transition they've got to go through. They've got to raise a lot of capital. They've got to go through clinical trials. And not only if the clinical trials are successful, they're then going to go and commercialise the product. They've got to get the marketing out there. So it's a multi-year process and a lot more go belly up than make it.
Love it. Lots of ideas. And of course, here on the Australian market, we have an ETF, the BetaShares ETF, which is drug. But Kim, Michael mentioned the US access and accessing some of those big exchange traded products over in the US or companies. But the performance has been quite varied as well. I mean, if we have a look at the IXJ, that's up 10%, the XBI up 31%, but that's equal weighted. And with biotechs, you know, if one of them tanks or one of them blows the lights out, it changes the performance of the whole index.
It's dartboard stuff, Julie. It really is dartboard because the whole thing about, I mean, I don't go near the biotech sector because it requires a level of specialisation in terms of investing that you've really got to have the background, as you were alluding to, you know, phase 1, phase 2, phase 3 trials, the amount of capital that get burnt in those. And, you know, you're lucky if you know, 1 in 20 or 1 in 30 make it. So I think, you know, there are easier areas to invest in biotech. Sure, you can shoot the lights out, but for every one that you get right, there'll be a hell of a lot more you get wrong.
But the ones that do go right, go extremely right. Michael mentioned CSL, $10,000 back in CSL when it floated.
What it floated.
Over $2 million it'd be worth now.
I think it floated at $2 a share or something.
But with all the buybacks, it's equivalent of something like 87 cents.
Exactly, but that was a really good business model to start with, and you know, finding other CSLs like that is, you know, we're going to be looking under a lot of rocks before we find one.
Well, that's exactly what we're going to do. Coming up is our stock in a minute. We'll put the spotlight on a biotech player tip to boost your portfolio. Details up next.
You're watching Equity Investor on Sky News Business.
Welcome back. My guests tonight, Michael Wayne from Magellan Financial and also Kim Slater from County Securities. And now it's time for our stock in a minute.
Thanks, Julia. In the beginning of the year, I flagged a key theme for my sector to see an increase in licensing and M&A activity. We've started the year seeing significant bids for the companies like Certex, Viralytics, and RSTest. The next company on our list is Bionomics. Bionomics is focusing on diseases of central nervous system disorders, such as anxiety and Alzheimer's. The stock's had a good run, and we still think it's compelling value because it has multiple clinical and partnering catalysts ahead. Its lead asset, BNC210, is in a phase 2 post-traumatic stress disorder trial. It's just completed recruitment and we're expecting results in the third quarter this year. We expect a multi-million-dollar at the back of it. It is also in the process of divesting its non-core oncology assets. This will make for a cleaner story, and we think will give it a better takeover appeal. It's also got a very strong partner in Big Pharma Merck & Company, who's also a shareholder in the company.
That was Tanu Jain from Bell Potter, who of course is the analyst of biotechs and healthcare. So I guess an expert in this space, and she likes this one. And I suppose with a lot of these biotechnology companies, they don't have deep pockets. So when you partner up with a Merck, what you're hoping for down the track is, I guess, a partnership deal or a takeover once some of your research has been de-risked. Looking at Bionomics, I know that anxiety, post-traumatic stress syndrome disorder are big areas. And I guess the one that wasn't mentioned is something like depression, which potentially down the track and would be a massive market. Michael, looking at Bionomics, what's your thoughts? The stock did reach a year high today, so a good.
Yeah, it's obviously had some good news flow, or someone's taking a position in that, and more often than not, they do have great stories. Many of these are either looking for a cure for cancer or treating some of these issues that people come to, and more often than not as well, the potential access to the market is enormous. There can be billions of dollars in market per year if you can sort of get a foothold. So this particular one, it's a loss-making business, but they're not trying to make money at this point point in time. They're trying to get these clinical trials done and trying to prove to doctors that the take-up of this new procedure or the new drug that they're putting forward is better than the old thing. So still a long process to go, but if you are going to invest in these sorts of things, an expert like that one is probably a good way to go about it. Or another way you can do is build a sort of mini portfolio within your broader portfolio, rather than just trying to pick one or two. Maybe look for 5 or 10, and then hopefully out of that you might get 1 or 2 if you're lucky.
I mean, Tanu has a great track record in picking through some of these smaller biotech companies. It is presenting at a major conference over in the US next week, which might be behind some of the run-up we've seen in the share price. When you look at a smaller biotech company, Kim, what is it that you're looking for?
I think there's some similarities between small biotechs and small mining companies, Julia, and that is what shapes the balance sheet in. Because one thing that those two sectors have in common is cash burn. So how much cash is on the balance sheet?
Okay, we've only got a couple of minutes left, and I do want to get to one of my favourite segments of the show, and that's getting across what our panel is buying, holding and selling. And starting off with you, Michael.
So a bit of a different one today, a company called Shryro, SHM is the code there. Basically they distribute a lot of consumer goods. So historically they've had things like Casio calculators that go into all the schools, Casio watches. But an interesting move that the company's made is they're moving into barbecues. So they've paired up with like Heston Blumenthal, the chef, and they're looking to capture about 1% of the market in either the US or in the US and Europe as well. So it trades in a multiple of about 9 times earnings, a dividend yield of about 8%, fully franked. It's quite a mature business, but the way the market's pricing it at the moment is pretty much as that mature business. However, I do believe that you're getting basically a free option, if you like, on their expansion into the US with these barbecues. So worst case scenario is I think you'll just see the steady state continue. You'll collect your income and your yield, but you do have the option potentially that this company could make it overseas.
We like a bonus deal.
Frank yield or something like that. It's quite good.
So Shryro Holdings, a strong dividend yield, mature business, but you've got that extra bit of growth. How about you, Kim?
0, Julia.
0.
Because I just think the next stage of expansion with this business is definitely the US, and we've started to see some signs of that coming through. Share prices, recovered back to about $35, and I think we're now going to see that growth in the US. We're still seeing more profitability come from the Australian market, particularly. We'll see the share price get the high 40s probably in the next 12 months.
Interesting company. So looking at service as a software, and you can interact with Xero now in banking apps like NAB as well, which sort of streamlines the whole business experience, especially for people who don't like doing the accounting side of their business and their company accounts. Is that one you've looked at all?
I have looked at it in the past. I've had sort of a couple of clients take positions here and there. It's never been a sort of an out-and-out buy for us, but it's certainly a new age business in that cloud space. They're expanding very, very well into the US, starting to get a lot of traction and win some market share. And this was a company that really backed themselves through the early stages. They weren't profitable for so long. The market really was pretty negative towards the fact that they weren't being profitable, but the reality is they're just reinvesting all that revenue into their expansion phase, and it's starting to really come off for them. So worth keeping an eye on if you haven't already got a position in it.
And I think they are going to be free cash flow positive in the next year, but they're going to reinvest all that. So,
well, it's that type of business where if you're buying it for dividend growth, forget about it. If you're buying it for capital growth, you've got a lot of exposure there to some uncertainty, because these things never run smoothly. If you look at the volatility in the last 2 years, share price was as high as 40, as low as 15.
And that's all we have time for tonight. We hope you've enjoyed the program. A big thanks to my guest, Michael Wayne from Magellan Financial, and also Kim Slater from County Securities. A reminder, you can watch the show anytime with Catch Up on Foxtel Go and on demand on Foxtel IQ. We also have a podcast which you can find at skynews.com.au, and if you're overseas, we're available on demand on australiachannel.com.au. I'm Julia Lee from Bell Direct. Thanks for your company.
Information presented on this program is general in nature. Viewers should seek their own professional advice before purchasing products or services. The producers of this program may receive a fee for commercial arrangements with companies featured in this programming. You're watching Sky News Business.